Coming up on this episode of Cornerstone Advisors Plugged In, a conversation with some of our industry's longtime investors. Get ready because we're talking the business of banking and what smarter banks might look like in the coming years with the heads of Patriot Financial Partners, a private equity firm led by our guests. And I'm going to say hello first to Kirk Wycoff so he can bring Tom into the picture. They're holding it down in the tough town of Philadelphia. Whereas my friend Steve Williams is enjoying balmier temperatures than we have on the East Coast out in our Scottsdale, Arizona headquarters. But we're gonna have some fun as we welcome Kirk and Tom to Plugged In. Over the summer, Steve and I started to talk about the characteristics of so-called smarter banks, and we did this against what are known as smart banks today, those that have good performance that people appreciate. But we're looking at what smarter banks might show in the coming years as they focus on their outcomes and not just certain activities. So as a cheat sheet, we're looking at banks that become known for being hyper efficient, nimble, data-driven, differentiated, and opportunistic. And so we just thought, given Kirk and Tom's experience in this space, we could pick their brains by weaving those themes into a conversation around moving even faster than you feel maybe you're able to, gauging a leadership team's strengths in tech and on the digital front, and really exploring business models that guys like these would gladly open up their checkbooks for. So we got some good stuff coming at you. In our last episode of Plugged In, we unpacked Steve Williams' Spotify playlist to keep things both focused and fun. We figured, why wouldn't we do the same thing for this one? I went into the vault, picked out some songs that I think would lend themselves to a fun conversation. We started this whole thing back with Tom Michaud way back when, and we've just continued to use it for these episodes, where we try to take a song and tie a lyric or two that can easily be applied to the state of banking. So that's my tee up for this new episode of Plugged In. You guys ready to roll?
All set.
All set. Here we go. Well, I am going to start with a guy who helped keep himself alive. And this is Freddie Mercury, who we thought we could borrow from his song by Queen, Keep Yourself Alive, because he talks about being told 1,000,000 times of all the troubles in his way. And so as I think about the state of banking at the moment, it's an industry that's getting smaller. But if you're a community bank, you have to think about how you can get bigger, play bigger, and run even faster. So I really wanted to toss this one out to Kirk and Tom and get their thoughts on how is that possible, given all the things that are impacting the industry at the moment.
Yeah, thanks, Al. Appreciate it. Happy to have Tom here with me today. How do you get bigger and run faster is a tough one given the problems of the last year and the regulatory environment we're in. But shortly after we make an investment, or as we're making an investment, we really assess the ability of the company to grow its loan book with customers. And everybody today has just finished up their year-end budgets, and I would suspect that 3/4 of them came up with not enough asset growth to generate the EPS that they were looking for. And so we do see loan purchases as part of budgets this year and plans, and credit quality has been good, so it's a good environment for that. But at the heart of core banking are deposits and loans, and on the loan side, we try and invest in markets that there's a fair amount of growth, and with CEOs that can recruit the teams that know the customers. So you can be in a great market like DC where you're sitting, and if you can't recruit the right team and the right leadership on the business banking or real estate banking side, then you're not going to win. If you have the best team there is in Memphis, Tennessee, you'll probably be fine growing your loan book. But the answer to the question, and with the move in rates over the last year and a half, is how many 8% floating rate loans can your team deliver in 2024? Would be the answer to the question.
Steve, you've had some thoughts about recruiting teams. You want to chime in and maybe build on what Kirk just shared?
Yeah, because Kirk, you said 8% floating rate. So how do you see the selection of teams changing from maybe more income property, CRE, to more C&I, owner-occupied, how do you get that right mix? And are you seeing your banks kind of change the character of their recruitment from those relationship managers?
Well, look, I mean, CRE was always the way to grow size because you make bigger, chunkier loans, um, and customers in the development of the hotel business are always coming back for another one, right? They pay off, but they reload. The C&I business tends to be more stable. Companies don't grow their C&I borrowing needs 100% a year. So, we would see the C&I team being 2 to 3 times the size of the CRE team, particularly with the 300% guideline on CRE. And they're hard to recruit. And most of the recruitment we see, which we have some hesitation about, comes from B of A or Wells Fargo 2 years ago or other larger banks. And a lot of those people don't fit in a smaller bank, get it done now environment. But that's where we see their recruiting. Tom, anything to add to that?
No, I mean, I think that's definitely the key where we see people having success or where they've been in markets for a long time. They've established networks. They know the small business community, and they're able to bring the right people into the bank to drive growth. And where you can do that, you can be pretty successful in terms of carving out a nice niche in the marketplace and doing pretty well financially.
Yeah. And I do agree, sometimes taking those big bankers and turning them into entrepreneurial bankers, but the ones that can mint those kind of players over time is I think where you see the entrepreneurial banks thriving.
Yeah, we are an investor in one bank that has a team of eight C&I lenders that produces $250 million a year. And the good news is that they do it. The bad news is every one of them has got an offer from the competition in the last 90 days. And so we just at a board meeting this week put in a retention plan that had a 3-year cliff vest at one-time salary, in addition to any stock incentive plan or annual bonus. So the other thing is, let's not start with recruiting. Let's keep, when we invest, if we interview the team that's there and can get it done, let's keep them.
Yeah, absolutely. And thank God we don't have a transfer portal in banking, right?
Oh gosh, the fact that we are even having to use the transfer portal at this point. Well, in the conversation around boards, let me switch over a little bit, because it strikes me that this has been a year where boards have been asking their leadership teams just how resilient and efficient their balance sheet, really is. So I want to borrow on that theme, and technology is such a major driver of potential opportunity. The tools that are available are pretty compelling, but they're just tools. So I'm curious, how do you gauge how resilient your, bank's leadership teams are when it comes to technologies that are available and their digital positioning at the moment and where they want to go?
Oh, that's a mouthful. Look, your digital positioning has to do with your customer experience and how efficient the bank is. So we've already talked about being efficient. One of the ways you get to be a 50% efficiency ratio financial institution is deploying technology in account opening and in loan opening and loan underwriting, credit algorithms, et cetera. So, the management team the tech team has to be efficient at that, has to be good at that. Their tech development plan has to look out 3 years and be constantly implementing the solutions that are driving costs down. So that's the resiliency or the plan on the tech. The resiliency of the balance sheet really goes to how good management is at managing interest rate risk and credit. And 2 years ago, I would have said credit and interest rate risk. And 5 years ago, I would have said credit and interest rate risk. But if you go back into the 90s, unfortunately, when I was running banks, we had the interest rate risk management tools then, and we used them in 90, 91, 92, and 03, 04, 05. And we got a little complacent as an industry in actually reading, not the tea leaves, but reading the data in 21 and 22. And so you see only about 20% of the industry today, in the size we focus in, banks under 10 billion, have resilient balance sheets. And you've seen the ones of those that are public, their stocks move dramatically over the last 60 days. And the ones that aren't so resilient and have a hole in their balance sheet, not only in AOCI, but in their loan book, those stocks are not getting the market acceptance. And so a resilient balance sheet today means that you don't have a mark on the asset side of your balance sheet of 40 or 50% of your capital. And I think half of our target universe does have that big a mark.
Yeah, and on the loan side, Kirk, it's showing up in they're just not getting the asset yield pickup they should be given all the rate increases, and that it's showing the implied economic losses of the loan book, not just the bond book.
Agree with that, and the ability to grow loans. I mean, if you think about the bank with a $2 billion loan portfolio in static interest rate times would have 500 or 600 million in payoffs a year and grow 10%. So they'd have to make 700 million in loans. That means your loan book turns over pretty much in 2.5 to 3 years. So, I was looking at budgets actually yesterday where I'm seeing 10 or 20 basis point change in overall loan yield, December 23 to December 24. That's not enough. That means you haven't done your work on your interest rate risk.
Yeah, the only thing I wanted to add to that with respect to, resiliency of the balance sheet really goes to the funding side. I think we really saw this back in the spring and the summer where those franchises that had low cost deposits, non-interest bearing deposits, they fared pretty well throughout the crisis versus people that were wholesale funded that saw those costs go up dramatically right away and were managing kind of the fixed side of the asset part of their balance sheet really got squeezed and their balance sheets were not efficient or resilient. And they got the most pressure during the summer. And the good solid franchises and the deposit bases that we talked about earlier, those balance sheets were pretty resilient.
Yeah. And a lot of people have that regret. Like, I wish I had the capacity to be getting those 8% floaters, but I just don't have the room in the balance sheet right now. So because of the marks and because of the fixed rates.
It's worth noting when we size a bank that needs capital for whatever reason in 8, 9, 10, 11, it was credit. Now it's because of interest rate risk and balance sheet holes. We size that bank based on their non-interest bearing deposits. So if you don't have 20% non-interest bearing deposits, either you had them and you've over leveraged or you brought in more money markets or more CDs. You have to grow your non-interest bearing essentially at the same or a faster rate than you grow your balance sheet to have what you call resiliency. I would call it profitability. Resiliency leads to double-digit return on equity.
I'll move my language over to yours, Kirk. No problem. And actually, what I find interesting, I had pulled a song by Fitz and the Tantrums, Head Up High, because the lyric is, I got a headache and a heartache. I'm running circles trying to find another finish line. And so what you just described basically is why we pilled that song. Now, I'm going to give Steve a little toast from across the country with our plugged in mugs, which I know we sometimes like to give the virtual clink, because this song is a Steve Williams song, if ever there was one. It's by Motley Crue. It's Dr. Feelgood. And Kirk, we're going to have you be Dr. Feelgood because we want you to make us feel all right. And we really want to get a sense of your vision on the future of regional and community banks vis-a-vis their business models. What are you willing to write checks for looking ahead?
So it's and people should know we didn't script this question, but I'm going to do better than make you feel good. I'm going to make you feel great. The worst environment for community banking that could exist, and for Patriot, for 2 of our 4 funds, has existed over the last decade with very low rates. And so in April and May of this year, when the proverbial stuff was hitting the fan, we went back and revisited our core business model of what a $2 billion bank looks at and how fast we can compound capital in a $2 billion bank with normal interest rates, which I would call today normal levels, even though the curve's not sloped. And the answer is that bank with an 85% loan to deposit ratio and a 3.5% margin and a 60% efficiency ratio and normal charge-offs earns 15 on equity and 1.2 on assets, and it always will and always has. And that means you're going to compound your equity for your shareholders about every 6 years, maybe 5.5, which is our investment period. So the takeaway from that is, once your balance sheet is normalized to today's rates, which could be today, could be a year or two from now, the next 10 years in this business, where we're never going to see zero interest rates again, we're going to make multiples of the money at Patriot and at your banks that we made over the last decade. So this will be the golden era of community banking, and add some M&A onto that. And we're going back to 3 times book for exit models.
Wow, there's
That
the
makes me
quote
feel
of the
great.
year. We going back to 3 times book for exit. There we go. Dr. Feelgood is playing through the speakers right now. I love it. Well, and I think so you must disagree with Steve Eisman saying banks are uninvestable at this point. It sounds like you're saying it was the shock of the rate increases that wounded the balance sheets. They've got to heal to today's rates, and that's at different paces depending on how well they were positioned, right?
Yeah, well, I think 2 parts of that. We like Warren Buffett's quote on that: the time to run into the burning building is when it's burning. And so we've been investing all year in equities. And the other part of that comment that's partially true, and this is now my 5th decade in the banking business, is whenever there's a banking crisis, and there's one about every decade, if you haven't noticed, the regulators show up about 6 months after the crisis and make it 3 times worse. And so, we're in that period now. October was 6 months after March. The exams we were privileged to see as directors of various banks that were done concluded in April, May, June, and even into July were fine. They were based on the original parameters for examining banks for 2023. And then the exams that were started after that and concluding in August, September, October, November had a totally different tone around liquidity, interest rate risk, capital, all for no good reason. Lots for banks that had 90% insured deposits and plenty of liquidity, but the playbook changed and it made it worse. And so to the extent banks are uninvestable, that's a phenomena that'll correct itself over the next year. Hopefully it'll get some accelerated correction in the election in November. But balance sheets kind of by the end of 24, I think will be all clear for a really good period coming up in banking.
Kirk, another follow-up on Dr. Feelgood, though. I look at Fund 4 at Patriot, and I've seen names like Ampersand, Core 10, Finextra. So it's not just traditional banking where you see an opportunity to write a check, but also some of the tech-enabled platforms and companies that are surrounding your community banks. Can you comment on that? And, fintech's been a little spotty the last 18 months. So where do you guys see the opportunity there?
Boy, spotty would make me feel good. It's been, it hasn't been spotty. The answer is we carve out a small portion of each of our funds to invest in companies, not fintech, bank tech, companies that can really accelerate the earnings of the 25 or 30 banks we have investments in at any one time. And we get those people introduced to our bank management teams so that they can have, an early advantage if they like the technology in terms of moving forward with a numerated or with, on loan automation, with a NARMI on account opening and business account opening. And so, we're obviously not investors in the big side of fintech, and it's a small part of our dollars, but the same analysis. Are the management teams really knowledgeable in their industry? Can they accelerate their revenue? But for us, can they accelerate bank earnings if our banks that we invest in deploy that technology?
Gotcha. It's a portfolio. It's a smarter bank. We would call it portfolio play for your partners.
Yeah, we would say it adds alpha to our portfolios, or at least we hope it does over time. It did in Fund 2, where we built Laurel Road, which was the large student lending company and up in Connecticut and sold that to KeyBank. We built a large foreign exchange trading company based on a tech platform. So it's added some alpha to our funds, which are, pretty consistent performers. And so the investors like that.
So, Kirk, you talked about running into a fire, and you reminded me of a conversation that Steve and I had with Gene Ludwig, who, most people remember as being the head of the OCC. But he was on an episode of Plugged In with us, and he talked about being a firefighter. And really, you don't form a committee to decide if you're going to go fight a fire when the alarm bell goes off. You just get after it. And so if I swap out the role of a firefighter for that of a bank CEO, I'm curious, sometimes you just have to hop into things. And I'd like to understand how you see bank CEOs striking a balance between the stability of rules against the rewards of risk.
How many bank CEOs do we have on this podcast? So I know how many people I'm going to offend when I answer this question.
Well, we can do the math. We know it's every one of them. They all listen in religiously.
All right.
It's like going to church. You're there every Sunday.
We have, rightfully so, in the banking industry, to continue your analogy. We have dispatchers and planners and county officials who fund fire departments. And as they say, rightfully so, because it is a rule-based economy. And I could name 5 bank CEOs that were firefighters over my career, and unless you're as old as I am, you wouldn't recognize their names because they didn't last very long. The shareholders generally aren't rewarded by it, and the regulators really don't like abnormal risk taking. And what I think firefighters do is take risks that you or I probably wouldn't want to take in your burning building. That said, I think about a third of the industry CEOs are very proactive and thoughtful when they see opportunities and take advantage of them. And I think those banks tend to be the higher ROE banks. The status quo in the banking business isn't working very well right now because it's harder and harder to bring on a zero cost checking account at a cost less than $300 in account acquisition. And it's more and more expensive to acquire that team or acquire that C&I borrower. So we like CEOs that can make things happen, and we invest in those people. And, we have plenty of examples of those people in our portfolio.
And I think they play a big role there, Al, in talent. Like talent follows CEOs that people see as opportunistic, not just the status quo. And I think that's when I've seen some of those entrepreneurial banks get those ROEs, it's because they brought in the relationship talent who believed in chasing that opportunity.
Well, look at Tony Lappinzetta, or look at, Frank Sorrentino, really, look at guys like that have really built banks. Look at Jack Kipniski, who retires at the end of this year as CEO executive chairman of Webster. We invested in Jack when Provident was $2.5 billion, and Webster is $60 billion. And, he believes, if he was on this call, he'd tell you that if you're not running your bank at a 45% efficiency ratio, you're not doing a good job. And so, those are, if you want to call them firefighters, we love guys like that, but taking too much risk has never been a formula for success in banking.
Well, we'll try to dub a little Ring of Fire by Johnny Cash over this part of the conversation. I think that would be the appropriate song. And Steve, to your point, I totally agree. I don't think people follow a title as much as they follow the person. And so, Kirk, you just raised some great names in the, recent history of banking that have done some great things and are continuing to do great things, which I think lets me kind of take us all home. The industry as a whole, gets described in a lot of different financial terms, but we'll be at Acquire or Be Acquired in January. And I'm expecting we're going to see some charts that show the sweet spot for banks in terms of asset size. I remember when 1 to 5 billion was considered just where you want it to be. It's moved up, 5 to 10. Now, I think you and I would agree there's some folks that think it's maybe closer to 35 to 50. How do you think about size in this industry and the proverbial sweet spot that gets investors like you thinking there's some really interesting opportunities still in front of everyone?
Well, the first thing I would say, as I said to you before we got on the podcast, is don't fall for the investment banking model of the year, which we'll all see at AOBA from all of the investment bankers. So, I would like to focus on ROE. So the reason we're in the size banks that we're in is we see efficiency, the efficiency curve being dramatic between 2 and 8 billion. But the whole goal is to be a 12 or 15% earner, which when I started in banking, because 6% was, or 4% was adequately capitalized, we had enough leverage that was normal. You see the biggest competitors getting back to double digit ROEs. Certainly certain debt products on the sub debt side have helped with that. But whatever size you are, you're going to compound your shareholders' capital if you're making 12 to 15% on ROE. So we can't invest in 20 and $30 billion banks because our check size is less than 50 million, and we wouldn't make a difference there. But we think, the heart of Patriot is with 18 people, we can make a difference in balance sheet diversity, interest rate risk management, product differentiation, digital development, because we see it every day.
Yeah.
Mm-hmm. Yeah. And I think if you look at the numbers in banking at the 4,500 banks left, there's a lot that will become some of those 2 to 8s, meaning they're 300 million or 600 million right now. And Wells Fargo is not going to go acquire them. It's part of the consolidation into that sweet spot, I think.
It's been interesting to us over 17 years. When we started in 2007, there were 1,100 banks in our size range that we targeted. And today there'd be 1,300. So some get acquired, but to your point, Steve, more come in. And that's where we want to be the provider of choice for capital in that 10 to $50 million range.
Well, it makes perfect sense. And, I'm going to look forward to seeing you guys out in Arizona in January for Acquire Be Acquired. Because my friend Steve is not able to join us, I'm going to ask him to take us home today. You want to wrap up this episode, Steve?
Well, thank you, guys. Kirk and Tom, always great to see you guys. I'm a little sad we didn't get horse racing in. That's got to be something we do the next time, but I know...
that's a 3 or 4 day podcast, Steve. That's not like
exactly.
a 30-minute conversation.
I want a beautiful bow tie and my gorgeous wife with a big hat in Kentucky.
First day of AOBA is 1/27 this year. That's a Saturday. I was at AOBA last year and missed our horse Atone win the $1 million Pegasus World Cup. He will be back this year, and Al, I won't be there till Sunday. I'm not going to miss it again.
I can't give you the official dispensation since I'm no longer in charge of bank director, but I know my friends there will at least give me a slight permission to say you're always welcome to join us, and we want to hear some winning stories when you do step foot in the desert.
Yeah, but I'll take it home out by saying it's fun to talk to Kirk and Tom because not only are they looking at this thesis of the sweet spot of banking and a new golden age, and we've had people like Tom Brown agree with Kirk's thesis that this is going to be fun, buckle in, but also the tech side of things. And we gave a Gonzo Banker Award to Kelly Brown for some of her work and what she's doing with you guys. So the collision of bank tech with the community banking model that's based on talent, I think this conversation now says to me it's alive and well. We're building smarter, nimble banks, and it'll be fun to watch the journey.
Well, thanks, guys. Thank you,
Thanks,
Steve.
guys. We appreciate it.
Thank you, Tom. Thanks for getting plugged in with Cornerstone.